With the possible implementation of a broad-based capital gains tax on the horizon, how does the government plan to tax a company's intangible assets gains? Paul Adams, CEO of Everedge Global, a company that helps businesses identify, manage and make money from their intangible assets, said it won't be easy. He said international research has found that about 90% of all company value today is in intangible assets. That compares with only 17% back in 1975. But most companies still don't put a proper value on intangible assets, and neither do accounting standards. Mr. Adams said the shift from fixed to intangible assets changes everything about the way a business is financed, valued and taxed. But the government has not properly considered that when it comes to a possible capital gains tax or its proposed digital services tax.
The accounting standards that really drive how we look at companies and company performance and company reporting really were designed for an industrial age economy where fixed assets dominated. And the problem is they no longer capture or really reflect the value of these intangible assets.
So it's more than just goodwill, isn't it?
Absolutely. It's things like data, content, brand, code, trade secrets, regulatory approvals, confidential information, patents, systems and processes. All of these things, and they are unbelievably valuable, and they're also where virtually all economic growth is coming from today.
Hospitality entrepreneurs Andrew McIntosh and Scott Brown are seeking to raise $3 million from sophisticated investors for a boutique hotel development in Wanaka. Mr. McIntosh's company, B Property Group, wants to build a 35-room lodge on a former mini golf course in Wanaka, purchased 2 years ago for $1.45 million. Mr. McIntosh said price was why the project had not got off the ground earlier, but that has been overcome by looking to modular construction, which works like Lego, with assembly time to take just 8 days. The hotel was scheduled to be open for business from July or August. A specialist bike maker is hoping to raise up to $2 million through crowdfunding to continue its overseas expansion. The Auckland-based company, Chapter 2, makes high-performance carbon road bike frames and has sold more than 1,533 countries since launching in July 2017. The public offer, which will kick off on snowball effect in the next 2 weeks, is for 40% of the company at $1 a share, valuing the business pre-money at $2.5 million.
Chapter 2 is a little bit different because, we have strategically positioned ourselves as a very boutique brand. So in the world of road bike racing, there's the big guys that specialize in the treks and things like that, and they have a big footprint around the world. They're able to distribute all around the world. But, for those people, those discerning customers who are looking for something really unique and different, that's the kind of customer that we're going after. We're not going after those guys who just want to buy a really great bike and roll on the street. We're looking for a statement product. Our products are really well designed, engineered, and the graphic designs are incredibly unique in the market.
Snowball Effect is also about to launch a second crowdfunding campaign for utility electric vehicle maker UPCO to fund its launch into Europe. The company aims to raise up to $5 million with a wholesale element. Civil Contractors New Zealand CEO Peter Silcock said the rate of change in the construction sector is concerning, with contractors still taking on too much risk as other firms continue to collapse. Mr. Silcock said he isn't surprised by Arrow International's voluntary administration last week. In the wake of eBert Construction's collapse last year, Cabinet ministers met construction industry leaders to discuss ways of resolving the issues. The result was a construction skills action plan, which focuses on using government procurement to increase labour training, establish additional jobs and build careers. Mr. Silcock said discussions also continue over a possible construction accord. He said similar agreements have been signed in the UK and New South Wales with positive results.
I think everyone's recognised that we need to change. The rate of change is probably the area of concern for us. And of course, our members are dealing with, particularly a company like Arrow. Often the contracts, run over 2 or 3 years. So it's not a matter of changing the contract model or the contracting model overnight. But ultimately, we need to look at more collaborative approaches between clients and contractors. The better relationship between client and contractor, then that passes down, so it'll be better relationships usually between the head contractor and subcontractors.
A group of long-term forestry investors fear their investments have been squandered in light of the closure of a Whanganui sawmill earlier this week. The Waverley sawmill was partly owned by a group of investors who put $13 million into several forestry syndicates in the 80s and 90s, managed by another Whanganui company, Arbor Management. The plan was to buy land, plant trees and harvest them decades later, with the prospect of a 5 or 10-fold return. But more than 20 years later, investors are yet to receive a cent, and a failure to file accounts, in some cases since 2016, is ringing alarm bells. Some unit holders have complained to the Financial Markets Authority, but Arbor blames not filing records on flawed mixed-age forest valuation methodology and a continuing sales process for the syndicated forestry assets. And taking a look at the markets this week, Fat Profits research head Greg Smith analyses the week.
It's been an interesting week. I mean, obviously Wall Street, as you mentioned, has certainly meandered along. That's an absence of any fresh news on the trade side in particular, and also post the earnings season. Of course, New Zealand earnings season is also pretty much out of the way, but our market's done quite well this week. And in fact, it hit another record high, up 10% since those late October levels. And interesting as well, actually this week marked 10 years since the bull market run started. US markets are up over 300% in that time, and the Kiwi market also isn't too far off.
And looking ahead to next week, our Shoeshine columnist says accountants have gone too far this time when it comes to company accounts. So for more on that and other stories, head to nbr.co.nz.